Okay, welcome to the last section for the new sums of May 22. We will go to business combination. Now this is a fairly lengthy question. I would request you to read it at piece once. This has come in the November 21 questions. It is linked to business combination and put inside business combination. Having said that, it has a very strong linkage with joint arrangements as well. So before we go into this question, we will have to understand a bit of background. So when we look at Ind AS 111, this is a standard on joint arrangements. You have two separate possibilities. There can be a joint operation or there can be a joint venture. Joint operation generally comes into existence when there is no entity in the middle. If there's no entity in the middle, then the partners have a direct share in the assets and liabilities, and because the partners have a direct share in the assets and the liabilities, the method of accounting to be used is proportionate consolidation. That is, proportionate, all assets, all liabilities will be consolidated in the books of each of the joint operators or the co-venturers, as the case may be. Now, in case there is a separate entity in the middle, what we will recognize is investment in the joint venture and then account it for using the equity method under Ind AS 28. So this is a question where there is no incorporated entity. So there may be an unincorporated entity, for example, a partnership firm. A general partnership is unincorporated as per the Partnership Act of 1932, in which case the partners have a direct interest in the assets and liabilities. And as a result, if there is an unincorporated entity in the middle, the joint operators directly have an interest in the assets and liabilities, and hence proportionate consolidation method is to be followed. Okay, so we will keep that in mind and also have to study an additional aspect in joint arrangements which is not as clearly discussed in your study material earlier. So this is that way a fairly fresh concept and a fairly fresh application. So we will first study it, understand it, look at the nitty-gritty and then proceed. Okay, so this is something which I would definitely rate as important from a revision standpoint. So mark it as very important rather. Okay, let us read this once. Company X is engaged in the business of exploration and development of oil and gas blocks. Okay, so probably it is an explorer like Bharat Petroleum or let us say British Petroleum, who is into exploration of oil. Company X currently holds participating interest. That is basically stake, a participating stake in the below mentioned producing block. So for example, there is an oil block off the coast of Andhra Pradesh on the Krishna Godavari basin where oil exploration is happening, and we have a direct interest in that particular asset as follows. So the block name is AWM01. Company X has a 30% stake, company Y has a 60% stake, and company Z has a 10% stake, which totals up to 100%. So on the face of it, it appears that company Y is having control on the face of it because it has a greater than 50% holding on the face of it. For the above block, company X, Y and Z have entered into an unincorporated joint venture. Unincorporated. When we say unincorporated, it means like a general partnership, and because it is not incorporated, it cannot legally hold the block in its own name. So if shareholders come together, form a company, the joint stock company can hold the asset in its own name. However, if it is an unincorporated entity, it cannot hold the asset in its own name, and as a result over here, this on the face of it will result into what you call as a joint operation, where X, Y and Z will directly have interest in the block. X, Y and Z, they have as such an unincorporated entity in the middle, but because it is an unincorporated entity, it cannot hold the block in its own name, and hence effectively X, Y and Z will directly have interest in the AWM01 block, and hence ideally proportionate consolidation method should apply. Y is the operator of the block, AWM01, Y is operating it. X and Y are the joint operators. Okay, so it seems that they are working together. Y incurs all the expenditure on behalf of the joint venture. I mean, the word joint venture is loosely used over here. In legal terms, it will be a joint operation, and raise a call to company X and Y at each month end in respect of their share of expenditure incurred in the joint venture. So Y is the main operator and all of these partners have agreed probably to share costs, and Y will spend the money, and then it will raise a call or a bill for getting that expenditure reimbursed to the extent of X and Z's share. All the manpower and requisite facilities are owned by the joint venture and thereby owned by all the joint operators. So this language makes it amply clear that this is a jointly controlled asset. So it's not only controlled by Y or by any one party, it is jointly controlled. So there seems to be a joint arrangement, and hence Ind AS 111 will apply. There seems to be a joint arrangement. Okay, for the past few months, due to liquidity issues, company Z has defaulted in the payment of cash calls to the operator. So Y is operating, and then at the end of the month it is raising a bill. X probably is honoring it, Z is unable to pay. Therefore, company Y has issued a notice to Z for the withdrawal of their participating right from 1st of April 2011. Y has had enough. It says, okay, if you don't pay the money, you move out of this block. However, company Z has filed an appeal with the arbitrator on 30th of April. So has Z moved out? No. It has actually contested it and it has filed an appeal. Financial performance of Z has not improved even in the subsequent months, that is May or June as the case may be, and therefore company Z decided to withdraw the participating interest from block AWM and entered into a sale agreement with company X and Y. So Z is giving up its share in the joint operation to X and Y. अच्छा, Z का कितना share है? It is 10%. So this 10% is not fully given to X, it's not fully given to Y, it is given to both X and Y. In which ratio? Well, ideally it should be given, if not in the ratio of 30:60, that is 1:2 maybe. As per the terms of the agreement dated 31st of May 2011, so Z has agreed, it filed an appeal, but then it saw that its performance is further deteriorating, so it filed an appeal, entered into an agreement on 31st May 2011 that company X will receive 33% share and company Y will receive 66% of share of the participating interest owned by company Z. Company Z actually owns 10% stake in this block, and out of the 10%, 33%, that is 1/3 will go towards company X and 2/3 will go towards company Y. This is agreed, and this is probably in the same ratio, 1:2. Company X is required to pay 1 lakh rupees against the 33% share in the participating rights owned by company Z. So this is like the purchase consideration for purchasing the 33.33% stake or 1/3 of the share of Z. We will have to pay 1 lakh rupees. Okay, we have agreed. After signing of the sale agreement, the operator Y approached the government of India for modification of the production sharing contract. Now this is a national asset, right? A block, and as a result, nothing can happen without government's approval. What if Z's share is transferred to, let us say, an enemy country or let us say an enemy operator? So the government has said that we will not permit any change unless it has been approved by the government. So we will need the government's approval for the removal of company Z from production sharing of AWM, and the government has approved this transaction on 30th of June 2011. So this is the date when the government approves. If the government did not approve, this transaction cannot go through. The government approval for the modification of production sharing contract is essential given the industry in which the joint operator operates. Okay, so till the time the government approves, the control cannot transfer for that 10% block. That is 30th June 11. So there are various dates. Y has given notice to Z to withdraw from 1st April 11. Z has filed an appeal on, so this is Y's notice. Z has put an appeal on 30th of April 11. On 31st May 11, they entered into an agreement whereby Z is now agreeing to sell its share to X and Y. However, this is subject to government approval, and on 30th of June 11, the GOI, Government of India approval is received. So when can we say effectively that the control of the 10% stake is transferred? When the government approval is received, because the government approval is essential. It is like substantive. When you study Ind AS 103, there's a concept of acquisition date, and acquisition date is a date when the PC is paid and the assets are received or the control is obtained, unless an earlier or later date has been agreed. However, if the transaction is subjected to government approval, and the government approval, like a competition commission approval for example, is considered to be substantive, that is, without the approval you cannot proceed, then the acquisition will happen only once the approval is done, which is the case over here. So it seems that 30th June 11 is the relevant date. You have been given two dates and two balance sheets. This is for company X and company Z. This is on 31st of May 11, which is now irrelevant, and 30th June 11. 30th June will be the relevant date because this is the date when effectively the control can get transferred. The fair value of property, plant and equipment and the development CWIP owned by company Z as per the market participant approach is 5 lakhs and 2 lakhs respectively. So this is the fair value of the PPE. So this is 5 lakhs and the development CWIP is 2 lakhs. This is the fair value. Okay. The fair value of other assets and liabilities acquired are assumed to be their carrying values except for cash and cash equivalent. The cash and cash equivalents of company Z are not to be acquired by company X as a part of the terms of the agreement. Maybe Z needs that cash to pay the liquidator or whatever it is. So cash is not acquired. Other than that, everything else is going to be taken over at the carrying values. Okay, the tax rate is assumed to be 30%. If this is given, a deferred tax hidden adjustment is possible. As per Ind AS 28, all the joint operators are joint venturers whereby each party has joint control of the arrangement. So this point is trying to harp on the fact that there is a joint control. So on the block, Y does not have control, there is joint control, that is what is mentioned. Have rights to the net assets. Have rights to the net assets of the arrangement, and therefore every operator records their share of the assets and liabilities in his books. So, well, the words used are joint venture, but actually it is a joint operation. Having said that, the accounting treatment is very clear. They have said that the parties in question have to record their share of assets and liabilities in their books, and hence this is the accounting that you do in case of a joint operation. There is very clearly a joint control, and on account of that joint control, you are recording your share of the assets and liabilities in the books. Okay. Now, this question has been solved assuming in the books of company Z, there is only all of these assets, liabilities in the books of company Z are attributable to a block. So, all assets / liabilities in books of Z, this is what the institute has assumed, in books of Z are assumed to be due to Z's share in AWM 01. There is no other business or no other operation that Z has except for its share in the AWM block, whose 10% is getting consolidated over here. That is what the institute has assumed, and well, you have no other means to verify that because you have no other data to tell you that Z ka other business kya hai. So either you assume that nothing is attributable, or you arbitrarily assume that some of the assets are attributable, or you assume all of them are attributable to the block only. Okay, you need to determine whether the above acquisition falls as a business or as an asset acquisition as defined under business combination under Ind AS 103. Okay, we will discuss that. Determine the acquisition date, if any, for the above transaction. This I think we are fairly clear. Kya hona chahiye? Prepare the journal entries for the above mentioned transaction and draft the balance sheet of company X. We are not really bothered about Y. We have to look at company X based on an analysis in part 1 above as at the acquisition date. Okay, so if you want, just pause the video again and read the entire question. It is a fairly complex question. What is happening over here is there are 3 partners, X, Y and Z, who have control over a block which is AWM01. The question has said that this is a joint arrangement which will result in a joint operation on account of which X, Y and Z is selling its share to X and Y. 1/3 of its share is going to X, 2/3 of its share is going to Y. We are not asked anything in the books of Y, we are asked the accounting in the books of X. So ideally X is purchasing Z's share in the block. We have been given Z's balance sheet and we have not been given that other than the block what else is there in Z's balance sheet. So in line with the institute's assumptions, we have assumed that the entire balance sheet is attributable to Z's share, that is 10% share in the AWM block. So will the entire part be taken over? No. So how much will be taken over? Well, to the extent X is paying and acquiring its share, that will be taken over. So 33.33% will be taken over in the books of X. 66.67% of Z's assets and liabilities will be taken over in the books of Y. Now before we proceed, we have to understand a few clauses which are there in Ind AS 111. I think this is para 22 or something, I'm not very sure. Para 21A, yes, there is para 21A of Ind AS 111. What does it mention? Of Ind AS 111, it says that when an entity, either initially or subsequently, when an entity acquires additional stake in a joint operation, so in case additional stake has been acquired, additional stake is acquired or a stake is acquired initially in a joint operation, how will the accounting happen? Well, this paragraph says that you have to evaluate whether the joint operation is a business or not. So over here you have to figure out whether the joint operation is a business. So if the joint operation is a business, how will you define business? Well, business is defined as a business as per Ind AS 103 language. What does Ind AS 103 say? Business is an integrated set of activities whereby there are inputs, substantive processes which have the capability of generating outputs. So over here, is the AWM block a business? So is AWM 01, is it a business? Well, are there inputs? Are there inputs? Well, yes, there are assets, there are manpower, there are resources, a lot of things are being used. Manpower is there. Do we employ substantive processes which results in output? Unless given otherwise, this block is probably producing oil, it is probably producing gas. So is it producing output? The answer is yes, it is producing output. And what Y is employing over here? Y is the main operator. This entire language over here, if you go to see, it mentions that company Y incurs expenditure on behalf, they share the expenses, all the manpower and requisite facilities are owned. So there are processes in place. There are inputs as well as manpower, facilities, processes in place whereby you are generating an output. So one can conclude that AWM 01 is a business. It is an integrated set of activities. It is just, I mean, to be honest, if you know that below the surface of the earth there is oil, that is not business. You know that there is oil, however you have to have an integrated set of assets. You have to develop that oil rig, you have to employ manpower, you have to get that process in place whereby you are in a position to extract oil from the surface of the earth. So AWM 01 seems to be an operating block. Y is the main operator, X and Z are also joint operators. However, AWM is capable of generating output, and as a result we can say that AWM 01 is basically a business. And if it is a business, then Ind AS 111 says that if you are acquiring a stake, which can be 10%, which can be 3%, which can be 33%, if you are acquiring either a stake in that asset, or if you already have a stake, like X already has, let us say 30% stake, and it is now acquiring another 10% into 33.33%. So probably it is acquiring another 3.33% stake. So over here, X has an existing 30% stake, plus it is acquiring 10 ka 33.33%, which is it is probably acquiring a 3.33% stake. So the question arises that how should the accounting for this 3.33% stake happen? Well, the accounting for this 3.33% stake is governed by para 21A of Ind AS 111, which mentions that this additional stake that you are acquiring, is to be accounted in a manner which is exactly similar to business combination under Ind AS 103. So this is to be accounted. In a manner similar to business combination under Ind AS 103, which means you will take over your share, that is X will take over its share, that is 33.33% of assets / liabilities of Z. It will take over its share of assets / liabilities. You will compare it with the PC that it is paying, that is 1 lakh. The assets and liabilities, Z ke jo assets and liabilities of Z, this will be at fair value. And if there is any difference, there can be a goodwill or a gain on bargain purchase or a capital reserve, as the case may be, exactly Ind AS 103 application. So over here, Ind AS 111 and Ind AS 103 are having an interplay. So over here, you have a 30% stake in the block, you are acquiring another 3.33% stake. So the question arises, how will you account for the 3.33% stake additional? Well, whatever are the assets and liabilities of Z, to the extent they are attributable to you, you will recognize at fair value. You are paying 1 lakh for it, so that will be taken as PC. And if there's a difference, there will be no non-controlling interest. It's not full consolidation over here. It is proportionate. You are just taking over your share, not 100% of Z's assets and liabilities. And if there's any difference, it will be taken to goodwill or capital reserve under Ind AS 111, read with Ind AS 103. Another question that can come into your mind is, okay, under Ind AS 103, you used to remeasure your existing investment. Sir, utna to hum soche nahi, but agar kisi ne soch liya to, you already have a 30% investment in this block. So do you need to remeasure it? Ind AS 111, para 33 or so specifically prohibits you from doing that. It says that if you are a joint operator who has an existing stake and it is acquiring an additional stake, well, the additional stake that you are acquiring will be recognized based on the fair value of the assets and liabilities of the block. However, the existing stake will not be remeasured. This entire para has not been given in the institute's solution, so we have added that in the institute's answer. We have modified the solution and we have put that in italics so that you can refer that from the bare extract of the standard. Having said that, the institute's answers appear to be correct, just that they have not given you the detailed explanation for the same, which we have tried to incorporate. Okay, so over here, first of all, the question tries to ask you whether the above acquisition falls as a business or as an asset acquisition. Well, AWM01 seems to be a business because there seem to be processes in place, substantive processes in place, which are capable of generating the output, that is oil or gas as the case may be. There seem to be substantive processes in place. And as a result, it will be treated as a business, in my opinion, which the institute has also mentioned. Second is, what is the acquisition date? Well, the acquisition date can be one of these 4 dates. Well, it is a date when control is transferred, and because the government approval is essential in this case, the acquisition date should be the date when the government approval is received. The parties have agreed on 31st May, but till the time government approves, the control cannot be transferred, and hence 30th June 2011 seems to be the date when control is transferred. Prepare the journal entries for the above mentioned transaction. Journal entries in the books of X, everything is asked in the books of X. So in the books of X, you will take over assets and liabilities of Z. as on 30th of June 11, you will take over the assets and liabilities of Z. So you will take over the PP. Since you are going to apply Ind AS 103 type of accounting, you will take over your share, that is 33.33% based on the fair value. So this is 5 lakhs. Achha, if nothing is given, then the carrying value will be taken. So we will take 20,000. Let us say this is the carrying value. Then loan receivable will be at 50,000. We are assuming everything is attributable to the AWM block. 30,000. Trade receivable is 1 lakh. You will not take over the cash equivalents as specifically instructed. Other current assets is 50,000. Share capital and other equity are not taken over. Under business combination as well, you don't take over, you take over the assets and liabilities, not the share capital and reserves. Provisions 2 lakhs. Other liabilities 1 lakh, and this seems to be merely the total. This merely seems to be the total. That's it. Trade payables are 2 lakhs. Okay, so will you take over? Will you take over these values? Well, yes. However, at the same time, you will also take over your share, against which you are paying 1 lakh. Now, the only challenge over here is this it? Are these all the assets and liabilities taken over? Well, no, because there will be a tax rate given, and since there's a tax rate, there is a potential for deferred tax as well. So over here, if you can see this, the journal entry for the time being would be, let us say, okay, I think this will work. PPE account debit, property, plant and equipment account debit. So this is, let's say, 5 lakhs into 33.33%. 5 lakhs into 33.33%. This is 1,66,650. Then ROU asset account debit, which is 20,000 into 33.33%. So basically what I will do is I'll not write this in bracket again and again. हर एक नंबर जो भी मैंने लिखा हुआ है on the right hand side उसको अपन 33.33% से multiply करेंगे. So this is 6,666. Then you have development CWIP. You will take this at fair value. Development CWIP account debit, which is क्या करना चाहिए आप बोलो? 2 lakhs into 33.33%, which is 66,660. Then there is loan receivable account debit. Loan receivable account debit, which is 50,000 into 33.33%, 16,665. Then you have inventories account debit. Inventories account debit, which is 30,000 into 33.33%, which is 9,999. Trade receivable account debit. Trade receivable account debit 1 lakh into 33.33%, which is 33,330. Cash you are not taking over. Other current assets. Other current assets account debit, which is 50,000 into 33.33%, which is 16,665. Then leave a couple of lines. There can be goodwill, there can be deferred tax asset as well. To, let us say there is provisions, to provisions, which is 2 lakhs into 33.33%, which is 66,660. To other liabilities, which is 1 lakh into 33.33%, which is 33,330. And to trade payables. So this is total payables, 2 lakhs into 33.33%. To trade payables 66,660. Okay, so if you go to see, this will give you all the assets and liabilities against which you are paying. So this is to bank, you are paying a purchase consideration of 1 lakh for acquiring all of these assets and liabilities. There's still deferred tax liability. You are paying 1 lakh. So there is bound to be a difference. Sir, deferred tax आप कैसे बोल रहे हो? Well, because you have been specifically given a tax rate. And how will you calculate deferred tax in case of a business combination? You compare for the net assets. You compare for the net assets. You compare the carrying value, which is basically the fair value as per Ind AS, with the tax base. The tax base is typically the tax base given in the question, and if it is not given, the old book values are taken as a tax base. So if we look at, I mean, there are various ways in which you can solve, but if we look at the fair values of only these two items have been different. I mean, you can take all the numbers if you want to, and Institute has probably taken all of them. However, for all the other numbers which I am highlighting in red, 20, 50, 30, 1 lakh, 50,000, 2 lakhs, 1 lakh, 2 lakhs, for all of these items, the carrying value as per Ind AS, which is a fair value, will be the same as the tax base, which is the old carrying value. So the differences, if they arise, are only due to these numbers that I am highlighting in yellow. So over here, the relevant net assets as per Ind AS can be the PPE, can be the development CWIP, and that's it. Acha, the development CWIP is 2 lakhs into, I mean, you can take 33% at the end as well, but otherwise 2 lakhs into 33.33%, and the PP we have already calculated is 5 lakhs. This is 5 lakhs into 33.33%, for example. Acha, the old carrying value, so this is 5 lakhs into 33.33%, which is 1 lakh 66,650. 2 lakhs into 33.33%, 66,660. So what you are taking over at fair value as per Ind AS is 166,650 will be 2,33,310, and the tax base, which is the old carrying value, will be, let's say, 3 lakhs into 33.33% and 1 lakh into 33.33%. So this is 3 and 1. So if I were to record this is 33,330, and 3 lakhs into 33.33% will be 99,990. So the value as per income tax will be 1,33,320, and if I were to take the difference between these two, minus 233,310, it will be 99,990 if I'm not wrong, and the tax rate is 30%. So over here into 30% will be 29,997. So the carrying value of the assets is greater than the tax base, and hence this will result in a deferred tax liability. I will need to verify this if I'm going wrong. I'll just verify this once. They've taken the total values. Where is the deferred tax working? Yes, deferred tax is 29,997. Perfect. So this is what we got as well, 29,997. They've done it through a slightly different way, but nevertheless that will work. So this is to deferred tax liability through a separate working note, 29,997. So basically, for your understanding, what we can now see is, well, all the assets and all the liabilities of Z, to the extent we have acquired, are taken over, and against that we have paid 1 lakh. So on your calculators, 166,650, 6,666, 66, अरे कितने 6, 16665. रात को भी अपने को अभी ये 6 नंबर ही दिखता जाएगा. 333330 16665 minus 6660 minus 33330 minus 6660 minus 29,997. So this is coming to 1,19,988, for which you are paying 1 lakh, and hence there is a balancing figure. of I think 19,988, which can either go to the capital reserve directly or it can be shown as a gain on bargain purchase, because we can clearly see that we have got this at a bargain because Z has liquidity issues, and hence this can be shown as a gain on bargain purchase in the OCI. Gain on bargain purchase in the other comprehensive income. This can be shown. Let me just verify whether this is correct. Your gain on bargain purchase, that's right, 19,988 is what we have also obtained, and that should take care of your overall journal entry. So this is your journal entry where 19,988 comes. Let me just verify this journal entry as well. So you take over all of these assets, you take over all of these liabilities, including the deferred tax liability, you pay the purchase consideration, and there is a gain on bargain purchase. Perfect. Acha, so this is the new part that we have added. This is not there in the institute's solution, so you can refer the one in italics. But nevertheless, if you were to prepare the draft balance sheet, it is fairly easy. To these numbers of X, you will directly add. So if I were to prepare the draft balance sheet, to each of these numbers of X, I will add the PP, etc. So this is 10 lakhs. How do I do it in the best way? Chalo, theek hai. PP of 10 lakhs, I'll just add. So this is 11 lakh 66,650. Right of use asset 2 lakhs hai, so this is 2 lakh 6,666. Development CWIP is 1 lakh 66,660. Loan receivable is 50 and 16, so this is 66,665 for loan receivable. Inventories, so 1, 2, 3, 4 taken. Inventory is 999, so 2 lakh 9,999. Trade receivables 33,000, so this is 3 lakh 33,330. Cash equivalents, you have actually paid. You have not received anything, but you have actually paid 1 lakh. So less 1 lakh ho jayega. So this will be 3 lakhs. Your cash equivalent, you will reduce 1 lakh over here because you have paid. So this is to bank 1 lakh reduction. Other current assets 16,000 से हमारा add होने वाला है. So this is 66,665, and this should take care of all the assets for combined X. Equity share capital, unless given otherwise, remains the same. This is 3 lakhs. In other equity, along with 3 lakhs, there will also be a gain on bargain purchase, 19,988. So this is 3 lakh 19,988. In provisions, 66,000. So this is 8 lakh 66,660. Other liabilities, 3 lakh 33,330. And trade payables, 66,660 is 6 lakh 66,660. Achha, apart from that, there will be a deferred tax liability of 29,997, and with this you have given effect to all the items in the journal entry. Now you remember all the gods that you know, and you will try to total up the balance sheet. 1166 6650 plus 206 666 plus 166 6 क्या है ये 166 660 66 665 209 999 33 333 3 lakhs 66 665. I think this is 25 lakh 16,635. We will have to verify this once. 3 lakhs plus 319 988 866 660 333 330 29 997 and 66 6660. 25 16 क्या बात है, 25 16 635. So let me just verify the total in the balance sheet as well. $25 16 635. So that takes care of the balance sheet. The additional language, if you go to see, I'll just read what is there. As per Ind AS 111, when an entity acquires an interest in a joint operation, so over here an entity is X, the joint operation is AWM, in which the activity of the joint operation constitutes a business. So we are assuming that the AWM constitutes a business as defined under Ind AS 103. It shall apply to the extent of its share all of the principles of business combination, and hence you have taken over assets and liabilities at fair value. You have created bargain purchase, you have created deferred tax liability. Accounting in Ind AS 103. This applies to the acquisition of initial interest. हमारे को initial interest यहाँ पे नहीं है, as well as additional interest. So in terms of additional interest, you are looking at that. So this is the additional interest, 10% into 33% in a joint operation in which the activity of the joint operation constitutes a business. Further, as per para 33C of Ind AS 111, a joint operator might increase its interest in the joint operation in which the activity of the joint operation constitutes a business by acquiring an additional interest. Okay. In such cases, the previously held interest in the joint operation, that is the existing 30% stake, are not remeasured, and hence you have not touched the existing assets and liabilities of X. If the joint operator retains joint control, refer part 3. So your accounting is based on this journal entry. Perfect. So this takes care of question number 1. It's a fairly important question. You'll definitely mark it as important. Okay, so the next standard over here is Ind AS 111 along with Ind AS 28. This is on joint arrangements. 2 questions over here. One is on equity method, which is on November 21 question. I would rate this as important. A similar question is there in the study material. However, a few additional adjustments are there. Application of equity method, and the next question is a fairly old question, must have been done. You might have done this earlier as well, but nevertheless, let us cover both of them. The first one is the more important question. On 1st April 2019, Investor Limited acquires 35% interest in another entity. Okay. XYZ. So investor acquires 35% interest. 35% will give you significant influence. XYZ. Investor determines that it is able to exercise significant influence over XY Z Limited. The investor had paid a total consideration of 47 lakh 50 for acquisition of its interest in XY. So this is like the PC. This is how much it has paid. This is the investment amount. At the acquisition date, the book value of XYZ's net assets was 90 lakhs and the fair value was 1 crore 10 lakhs. In case of equity method, you have to separately identify goodwill, and this goodwill is based on the fair value of the net assets that you have. Investor has determined that the difference of 20 lakhs pertains to an item of property, plant and equipment which has a remaining useful life of 10 years. Okay. So this 20 lakhs additional is due to the fair value of a PP which has a remaining useful life of 10 years. During the year, that is the year 1920 probably, 1920, XY made a profit of 8 lakhs, paid a dividend of 12 lakhs. It is paying a dividend of more than the profit it has earned. So probably a part of it is pre-acquisition dividend. We have discussed this even in our Ind AS 28 discussion, that in equity method, the moment dividend is paid, it is treated as a recovery of investment. We don't really care whether it is out of the post-acquisition profits or pre-acquisition profits. The moment dividend is paid, you reduce it from the carrying value of the investment. It is like a recovery of investment. On 31st March 2020, XY also holds a long-term investment in equity securities. So this is XYZ holding investment. Under investment under Ind AS, this investment is classified as FVTOCI, fair value through other comprehensive income, and hence if there is any change in the fair value, this would have gone in the other comprehensive income, probably fair value reserve. In accordance with Ind AS 109, and XYZ recognized an increase in the value of investment by 2 lakhs in the OCI. Equity method is going to reflect any changes in the equity balance, and equity does not just mean retained earnings or distributable profits. It is including any change in the equity balance, including a change in the other comprehensive income as well. Ignore the deferred tax implications if any, there's no tax rate given in any case. Calculate the closing balance of Investor Limited's investment in XYZ as on 31st March 20 as per the relevant Ind AS, which is Ind AS 28. So over here you will start on 1st of April 2019 with, let us say, the cost of the investment. So the investment that you made was costing 47 lakh 50. Acha, within this you will have to identify the goodwill separately. So you will have to identify the goodwill separately, for which you can prepare a working note. For the goodwill working, we can say that the purchase consideration, the PC that you have paid for the 35% stake is 47 lakh 50, and due to which you got a share in the net assets. Acha, these net assets kya hone chahiye? Well, these are 1 crore 10 lakhs. Sir, 90 lakhs is the book value. Well, that is right. However, when we calculate goodwill, we compare it with the fair value of the assets and liabilities taken over. So this is 1 crore 10 lakhs. 1 crore 10 lakhs into 35% will come to, I guess, 38 lakh 50,000. And if I take the difference between the two, 4750 will come to 9 lakhs, which is the excess payment that we have made. So we can identify that excess payment is attributable to goodwill. You can show this in a different manner as well. You can show the share in the assets and then show goodwill separately, or you can show it something like this. Basically, you have to identify goodwill, which we have. Acha, post acquisition, what has happened is you have earned profits. Now, in the equity method, profits affect the equity of XYZ, and as a result, if the profits are 8 lakhs, 8 lakhs into 35% is attributable to the investor. So this is 8 lakhs into 35%, which is 2 lakh 80. We could have proceeded. However, the problem is 8 lakhs is the value calculated in the books. In the books, the asset must have been recorded, let us say, at 90 lakhs. However, as per our working and in our goodwill calculation, the asset has been taken at 1 crore 10, and hence, in order to ensure consistency, there will be some additional depreciation. So there will be some additional depreciation in the consolidated accounts. So the share in the additional depreciation would be, well, 20 lakhs is the additional value of assets that we have attributed. This 20 lakhs is depreciable over 10 years, and hence 2 lakhs will be the additional depreciation. However, we don't have to bear the entire additional depreciation. We have to bear our share of the additional depreciation, that is 2 lakhs into 35%, and hence that is coming to 70,000. So this comes to 70,000. You can directly also take 8 minus 2 and 6 lakhs ka 6 lakhs into 35% as well. It will come to the same answer, and less your share in the dividend. Now this dividend is 12 lakh rupees. A part of it must be paid out of the pre-acquisition profits. It does not really matter. When we look at 4750, within that even the pre-acquisition profits are included. So this is 12 lakhs into 35%. A part of it may be post-acquisition profits recovered, a part of it may be pre-acquisition profits recovered. It does not really matter. You will always reduce the dividend. It is treated as a recovery of investment, like when you prepare the amortized cost table, whether you recover coupon or you recover principal, you always reduce it from the carrying value of the investment. Sir, is that it? No, you will also have to add your share in the other comprehensive income because it is a part of OCI. So this is 2 lakh rupees into 35%. So this is probably 70,000, and as a result, this will ultimately give us the total carrying value of the investment, 4750 plus 280 minus 70 minus 420 plus 70, which is 46 lakh 10,000. This will give you the carrying value of the investment as on 31st of March 2020. Let me just verify whether this is correct. This is 46 lakh 10,000. This is the closing balance of the investor's share. So this is a good question for your revision. A lot of small points like the fair value adjustment, the additional depreciation on account of that, the identification of goodwill, OCI item, pre and post acquisition dividend, all of these getting covered over here. So I would rate this as important. Achha, next question is a fairly old, it's a November 18 question. So this would in all likelihood be done. This is on joint operation, and the accounting using the proportionate assets method under joint operation. We'll quickly discuss this once again in case you have missed it. On 1st April 11, Alpha commenced the joint construction of a property. It is doing a joint construction of a property with Gamma. For the purpose of this, an agreement has been entered that provides for joint operation and ownership of the property. As clear as it gets. There is no entity in the middle, so there is no question of a joint venture. It is very clearly a joint operation. All the ongoing expenditure comprising the maintenance, borrowing are to be shared equally, 50-50. So this is maintenance, borrowing cost, everything. The construction was completed on 30th of September 2011. So it took 6 months to construct, and the utilization of property started on 1st of January 2012. So the property was ready for use on 30th September and it was put to use on 1st of January. The depreciation will start the moment the asset is ready for use, at which time the estimated useful life was estimated to be 20 years. We are assuming that this is estimated as on 30th of September itself. The total cost of construction of the property was 40 crores. Okay. Besides internal accruals, the cost was partly funded by a loan of rupees 10 crores taken on 1st of January 11. The loan carries interest. I make this 1st April if possible. 1st April 11. The loan carries interest at an annual rate of 10%, where interest is payable at the end of the year, that is 31st March. Make this March for easy workings each year. The company has spent 4 lakhs on the maintenance of such a property. Okay. The company has recorded the entire amount paid as investment in the joint venture. First of all, is that correct? Can you show this as investment under Ind AS 28? No, there is no entity in the middle, so there's no question of a joint venture. Joint venture hota hai, that is when you can recognize an investment and apply the equity method. However, because you are having joint operation and ownership of the property directly, this is very clearly a joint operation and not a joint venture, and hence the accounting is wrong. You can't show it as an investment. Instead, you have to show your share of the assets, your share of the liabilities, your share of the expenses, your share of the incomes in your respective books. Suggests a suitable accounting treatment for the above transaction as per the applicable Ind AS. Well, as per the applicable Ind AS, that is Ind AS 111, the suitable accounting for this would be the proportionate method, whereby if we look at the asset, the construction cost will be a part of the cost of the asset. Acha, what about the borrowing cost? Well, the jury is open. The time period is 6 months, so we can assume that it is not a qualifying asset and hence take the entire borrowing cost into the P&L account, or we can assume that 6 months is a substantial period of time, in which case you can capitalize. The institute over here has capitalized. Having said that, an alternative solution is very much possible. So over here, plus let us say the borrowing cost for the first 6 months, that is April to September, 10 crores ka loan hai, 10% is the rate of interest into 6 by 12. So this is probably 0.5 crores. So 40.5 crores will be the cost of the asset as on 30th of September 11 when it is ready for use. However, after that depreciation will start, and depreciation will be 40.5 crores divided by 20 years is the useful life, out of which half a year, 6 by 12 has gone by. So 40.5 divided by 20 and this is 1.0125. This is the depreciation, and as a result your carrying value will be 39.4875. This is the carrying value of the jointly constructed asset. Okay, apart from that, the loan will have a carrying value of, I guess, 10 crores. Interest assuming has been paid at the end of the year, and apart from that, in the expenses there will be the borrowing cost for the last 6 months. So you have taken the borrowing cost for the first 6 months into the cost of the asset, but the borrowing cost for the last 6 months would go to the profit and loss account. Apart from that, there will be certain maintenance cost which will also be recorded, which is 4 lakhs, assuming if there is any reimbursement, that reimbursement is received, but the total maintenance cost is 4 lakhs, that's 0.04 crores. Apart from that, there would be depreciation of 1.0125. Acha, in the books of Alpha, you will recognize your share of the assets, your share of the liabilities, which is 50%. So this is 39.4875 into 50%, which will come to, I think, 19.74375. 10 crores ka 50%, this is 5. 0.25 for the borrowing cost, 0.02 for the maintenance, and 1.0125 50% will be 0.50625 for the depreciation. This is the right accounting in the books of alpha as well as in the books of gamma. So this takes care of question number 2. Next you go to question number 1 within consolidation for subsidiaries. Again, this is a slightly older question with the May 2020 RTP question. You might have covered this. This covers the exception in preparing consolidated financial statements for an intermediate company. So the law goes something like this. If there is P के नीचे there is S1, S1 के नीचे there is S2, and S2 के नीचे there is S3. Ideally, S2 will have to prepare consolidated financial statements including S3. S1 will have to prepare consolidated financial statements including S2 as well as S3, and P will have to prepare consolidated financial statements comprising of S1, S2 and S3. So the law says that if the ultimate holding company is preparing, so P is the ultimate holding company, is preparing consolidated financial statements as per Ind AS, which is available for public use, then the intermediate companies may be exempted from preparing consolidated financial statements if they desire to, provided the intermediate companies should not be listed any or should not be in the process of listing any securities, debt or equity of these intermediate companies should not be listed or should not be in the process of listing, then they can claim an exemption. Acha, the law over here is if the intermediate company is a wholly owned subsidiary, for example, P owns 100% in S1 and P does not want S1 to prepare consolidated financial statements, then S1 will not prepare consolidated financial statements. Matter close. If it's a wholly owned subsidiary, then no intimation needs to be separately given. If the parent decides not to prepare consolidated financial statements, then S1 will not prepare consolidated financial statements. However, if let us say it is not a wholly owned subsidiary, for example, P owns or S1 owns 80% in S2 and 20% is held by, let us say, a company X. In which case, if S2 does not want to prepare consolidated financial statements, P can decide ultimately, because P has a controlling interest in S2. P can say, okay, I don't want to prepare consolidated financial statements. However, the other investor, that is X, it's a partly owned subsidiary. The other investor, that is X, has to give his consent, or he should not object to non-preparation of CFS. So basically, S2 will have to give an intimation to S. It will have to give an intimation to X, and X should not raise any objection for the non-preparation of CFS. Are we clear with this? So if it's a wholly owned subsidiary, no intimation needs to be given. If it's a partly owned subsidiary, then intimation needs to be given to the other shareholders and they should not object to the non-preparation of CFS, in which case S2 may also not prepare the CFS. Sometimes a challenge may arise whereby you can also see that sometimes P can also own 100% stake in X, in which case one can argue that, well, is S2 a partly owned subsidiary or is S2 a wholly owned subsidiary? The answer is it is a wholly owned subsidiary for the ultimate company P, because in S2 P has the ability to direct the relevant activities and it can control 80 plus 20, the entire 100% stake. 80 through S1, which it controls, and 20 through X, which it also controls, and as a result, it is a wholly owned subsidiary, in which case if P decides not to prepare CFS, it does not need to give any intimation. The only challenge over here is that the section or the clause is worded in such a way that the ultimate holding entity, so everything works for the holding entity. So if P is an entity like it is P Limited, then this entire working works. However, if instead of P Limited, this is Mr. P who is owning a 100% stake in S1 and then S1 is owning a 80% stake in S2, if it is Mr. P, then the ultimate controlling entity is actually S1. It's not P. Sir, P hai na, P control karta hai, yes, but P is not an entity, it's a person. And as a result, the evaluation will be done considering S1 as the ultimate controlling entity, and for S1, S2 is a partly owned subsidiary, in which case an intimation needs to be given. a lot of information has been thrown your way. If you have done this clause, you should be able to understand. Otherwise, we will do this as a part of the next question, and hopefully you should be getting a sense of what we are referring to. So we'll refer question number 1, the only question which the institute claims to have added in the consolidation chapter. So let us go through this. Question number 1. Well, Gamma is a parent company. Gamma Limited is a parent company engaged in the manufacturing and retail activities. So it is an entity which is operating as well. The group holds investments in the following entities. Gamma holds 100% investment in G&D Limited. G&D holds 60 and 40% in GD Limited. And Delta is a 100% subsidiary of GD Limited. Best understood through a chart. So there is Gamma Limited, which owns 100% stake in G Limited, in D Limited. So both of these are wholly owned subsidiaries, and each of these companies, they own 60% stake and 40% stake in a company called as GD Limited, and GD Limited in turn holds 100% stake in Delta Limited. Okay, so this is the group structure. Firstly, Gamma. Okay, so you are advisor to Gamma, the ultimate holding company. Gamma Limited wants you to suggest whether GD Limited can avail the exemption from preparing the CFS as per applicable Ind AS. So we have to see for GD. GD is an intermediate company. Unless given otherwise, we will assume that this is not listed. If it is listed, it does not have a choice. It will have to prepare the consolidated financial statements. We are assuming it is not listed. Achha, for Gamma Limited, is GD Limited a wholly owned subsidiary or a partly owned subsidiary? Well, Gamma owns effectively 60 as well as 40, and hence it is a wholly owned subsidiary. And hence, it may not prepare CFS, and no intimation needs to be given to any person, because Gamma Limited, which is 100% holder of the effective stake in GD, does not want GD to prepare, so it does not need to give any intimation to anyone. Okay, perfect. Secondly, if all other facts remain the same except that G Limited and D Limited are both owned by an individual, say Mr. X, instead of Gamma Limited, then explain whether GD can now avail the exemption from the preparation and presentation of CFS. So over here, instead of Gamma Limited, there is a Mr. X, in which case for GD Limited, the ultimate holding is now going to be with G Limited. Sir, the ultimate holding entity is G Limited, not Mr. X. Mr. X is not an entity, and hence it is a partly owned subsidiary. If it's a partly owned subsidiary, it may not prepare CFS. That is also fine. However, an intimation needs to be given as per law. An intimation needs to be given to D Limited, and D Limited should not raise any objection. And if D Limited does not raise any objection, then CFS will not be prepared. So that takes care of question number 1. Then you have a new question in the analysis of financial statements, which you will mark as important. It's a fairly detailed question of analysis, involves Schedule 3 application, so we can definitely mark this as important. There is another question, but that is a past RTP question, which is linked to the first time adoption, but this is a slightly more important question. Okay, so let us read this question once. This is on application of Schedule 3 largely. Master Creator Private Limited, which is a subsidiary of a listed company. Now, because it is a subsidiary of listed company, it has to prepare its accounts as per Ind AS. Is an Indian company to whom Ind AS are applicable. Okay. Draft balance sheet prepared by the accountant for the year ended 31st March 12 is given below. So this is the balance sheet as on 31st March 2012. You have assets, financial assets, other financial assets, capital advances. Capital advances have come under financial assets, which does not seem to be correct. They will go under other non-current assets, but not as a part of financial assets. Deferred tax assets, trade receivables, inventories, financial assets, investments, cash and cash equivalents, which should also be a part of financial assets. Equity share capital, other equity should be a part of equity and liabilities. It can't be a part of liabilities. There's deferred tax liability, there is a deferred tax asset, and then there is a deferred tax liability. Ideally they should be netted off. Borrowings, long-term provisions, which is a part of financial liabilities. Ideally they should be a part of financial liabilities. Then we have other financial liabilities, trade payables, which is also a part of financial liabilities, and then current tax liabilities. So there are certain errors which probably are there in the balance sheet. Additional information on 1st April 11, that is at the start of the year, an 8% convertible loan with a nominal value of 64 lakhs was issued by the entity. Acha, probably, okay, this is the entire 64 lakhs borrowings was issued by the entity. This was a convertible loan. It is redeemable on 31st March 2015 also at par. So this is a 4-year loan redeemable at par, that is 64 lakhs. Alternatively, it may be converted into equity shares on the basis of 100 new shares of rupees 200 worth of loan. So basically it is convertible into a fixed number of entities' own equity shares, and hence this is a optionally convertible loan, OCL, optionally convertible loan, where the option rests with the holder. Okay, so ideally as per Ind AS 109, you have to segregate it into the liability component and equity component separately. You can't be showing that as a single line item, that is borrowings. An equivalent loan with conversion option would have carried at an interest at 10%, and the interest of 5,12,000 has already been paid and included as a finance cost. Now, how did this 5,12,000 be calculated? Probably this is 64 lakhs into 8%. On your calculator, 64 lakhs into 8% is 5,12,000. So your coupon interest is taken as finance cost. Ideally, your finance cost will be effective interest, that is the opening balance in the liability component into the effective interest rate, that is 10%. So there is clearly an error over here. Now present value factors are given to you, so we will use that to find the liability component. So over here for the question 1 on the analysis of financial statements, you will say that, well, we have received 64 lakhs. A part of this 64 lakhs is attributable to the liability component and the remainder is attributable to the equity component. So this is 5,12,000. You are under an obligation to pay 5,12,000 over the period of 4 years, the discount factor being 10% had there been no conversion option, plus the principal. You also have an obligation because it is an optionally convertible instrument, so if the holder demands, you will have to pay. Present value factor at the rate of 10% for the 4th year. So these data points have been given to you. This is 0.68, and if I total these, this 0.91, 0.83, 0.75 and 0.68 will come to 3.17. So over here this is into 3.17. So this is 5,12,000 into 3.17 m plus 64 lakhs into 0.68 m plus, and if I total up, this is 59,75,040, and hence the balancing figure will be equity component, which is 4,24,960. Equity component remains unchanged, but the liability component will actually undergo a change. This is 59,75,040. The effective interest at the rate 10%, which will be the finance cost, will be 5,97,504. Coupon payment at the end of the year will be 5,12,000. This has already been paid, and hence ideally your appropriate closing balance would be 5,9 so plus 10% less 5,12,000, and hence your closing balance should be 60,544. So this will be your closing balance of your liability and your additional finance cost. You have recorded 5,12,000, and hence your additional finance cost. This will affect your P&L. So this is 597,504 minus 5,12,000 will come to 85,504. So effectively you will have to increase your P&L by so your adjusting entries, if you were to pass, will be your borrowings will be debited, and an equity component will be credited. An equity component will be credited to the extent of 424,960, and your borrowings will be debited to the extent of 424,960. This will take your borrowings to 595. or 59 lakh 75,040. However, at the end of the year, your borrowings should appear at 60 lakhs. So you will credit the borrowings. However, you will debit the P&L due to the finance cost. You will debit the P&L due to the additional finance cost that should have been recorded and has not been recorded of 85,504. You don't have to pass these adjusting entries. Having said that, over here you will if you go to see your borrowings, you will subtract 424 960, and over here there will be an equity component. This will be created, equity component of 424 960. Apart from that, you will add 85,504, and in the second effect will go in the P&L, whereby you will subtract 85,504. Okay, so this will take care of adjustment 1, which is an interesting adjustment. Second, after the reporting period, the board of directors have recommended a dividend of rupees 50,000 for 31st March 11. However, the same has not yet been accounted by the company. That is exactly correct. It should not be accounted. It will be accounted for in the next year. But if it is material, this can be disclosed in the notes to accounts. Having said that, there will be no effect in the financial statements. Third, other current financial liabilities consists of other current financial liabilities, and this is 2 lakh and 54. This consists of wages payable, which is a financial liability, salary payable, financial liability, TDS payable, this is other current liability. This is a statutory obligation and not a financial obligation, and interest accrued on trade payables is also a financial liability. So basically over here your other financial liabilities, may say you will subtract 81,265 minus 81,265, and you will show other current liabilities or other tax liabilities, as the case may be, of 81,265, which is not a financial liability. For TDS payable, other items will remain. Property, plant and equipment consists of building, which is a part of PP, which is held for administrative purposes. This is clearly PP. Land, it is held for capital appreciation, which means this should be investment property, not PP. Vehicles, they are used for conveyance of employees, so this is very clearly a PP. And factory premises, the construction was started on 31st of March 2012 and consequently no depreciation has been charged. The construction activities will continue to happen and it will take another 2 years to be complete and available for you. So this is capital work in progress. So basically these two items have to be removed from the PP total and shown separately. So PP, may say you will subtract the value of land, which is 1548,150, 1548,150, and instead you will show a separate line item, investment property, of 1548,950. Again you will subtract for 20,01,600, and you will show it separately as CWIP, capital work in progress, of 20,01,600. So this is more of a reclassification adjustment. Point 4 is done. Point 5, the composition of other current financial assets are as follows. Interest accrued on bank deposits, it's a financial asset. Prepaid expenses is basically other current assets. It's not a financial item. You have a contractual right to receive services or goods, not a contractual right to receive cash. And royalty receivable from dealers is also a financial asset. So basically 90,000 has to be subtracted from other financial assets, and instead that will be shown as other current assets. There will be other current assets to the extent of 90,000, which is on account of prepaid. This is also more of a reclassification adjustment. Okay, point 6, current investments consist of securities held for trading. Okay, if they are held for trading, they should be accounted for using FVTPL, which are carried at fair value through profit and loss. Perfect. Investments were purchased on 1st of January at 55,000 and are accordingly showing at cost on 31st March. That is wrong. They should be shown at fair value. The fair value of the said investments is 60,000, and hence there will be an adjusting entry that you will have to pass. That is investment account debit. You will debit this by 5,000. 55, so you will have to take it to 60. with the corresponding effect going to the fair value gain, which is basically a part of P&L. We don't have the income statement, but we will adjust it in the other equity balances. So over here, your investments, which will be a part of financial assets, will increase by 5,000. And the second effect of this will be against other equity, which will also increase by 5,000 over here. If a tax rate will be given, a deferred tax adjustment may also come. Trade payables and trade receivables are due within 12 months. So basically they will be current liabilities or current assets as the case may be. There have been no changes in the equity share capital during the year. So your opening share capital and closing share capital will be the same in the statement of changes in equity. The entity has the intention to set off deferred tax asset against deferred tax liability as they relate to income taxes levied by the same taxation authority, and the entity has a legally enforceable right to set off. So basically DTL and DTA will be set off. Unless otherwise given, you do set them off. So DTA is 2,54,000, DTL is 4,74,000. So basically you will set this off. This is 2,54,150 minus 254,150 in your DTL, net DTL. Other equity consists of retained earnings only. So this will help you in preparing the statement of changes in equity. The opening balance of the retained earnings was 21,25,975. Okay, this will help you in the statement of changes in equity, where your opening balance will be there, from which you will find the profit during the year, and separately we will also show the equity component. Okay, we will use this separately. No dividend has been paid by the company during the year. Fair enough. Assume that the deferred tax impact, if any, on account of the above adjustments has been correctly calculated in the financials. So there will be no adjustment in the deferred tax, and that is it. Being finance and accounts manager, you are required to identify the errors and the misstatements, if any, in the balance sheet. We have discussed these of master creator, and prepare the corrected balance sheet with details on the face of the balance sheet. No need to prepare the notes to accounts. After considering the additional information, provide the explanations wherever necessary. So basically, if you go to see in your balance sheet, your PPE will appear at 83,37,500 minus 15,48,950 less 20 lakh 1,600. So your PP will appear, I guess, at 47 lakh 86,950. Ideally इसके नीचे CWIP आएगा, but just for academic completion, your CWIP will comprise of 20 lakh 1,600, and your investment property will comprise of 15 lakh 48,950. Okay, within financial assets you will have security deposits, that is correct. However, this other non-current assets of capital advances will not be a part of your financial assets. They will be shown separately. Deferred tax assets will not appear, so that will take care of your current assets schedule. So this will have let us say other financial assets of security deposits will be 462,500, and other non-current assets separately will be 17,33,480. No deferred tax asset. Trade receivables current assets का ही part है. This will be a part of financial assets. You will first have inventories, which is 598,050. No changes. Financial assets के अंदर you will have investments, which is at 60,000. You will have trade receivables, which will be, I guess, at trade receivables at 7,25,000. Other financial assets comprising of 2,17,370 minus 90,000, which will be 127,370. Other financial assets. So this is trade receivables, this is investment, this is other, and then there will be cash and cash equivalents, which is 1,16,950. Apart from all of this, there will be other current assets, which is due to prepaid, which is 90. And this will take care of all the assets and liabilities. Just to reconfirm these items, PP 49 lakh 86,000 or 87,000. This is 20 lakh 1548 150. This is not 950, I'm sorry, this is 150. So this is maybe some typo over there. So that will take care of 49,87,750. So that is 49, 87, 750. It's just a subtraction of these two items. 20 lakh 1600, 1548, 150. Other financial assets, that's correct. Other non-current assets, correct. Inventory shown separately, then investments at 60, trade receivables, cash and cash equivalents, and other financial assets, and prepaid. So everything as per what we have decided. There is no change in the share capital, so share capital will continue at 10 lakhs only. However, when we look at other equity, in other equity you will have to prepare a statement showing the changes in equity. So within the other equity there are two items. There is retained earnings, and then there will also be an equity component. The equity component will be shown separately. Within retained earnings you will show the opening balance, and then you will show the profits for the current year. After making all your adjustments, your closing balance will be, so basically I think your opening balance is given to you as 21,25,975, 21,25,975, and after making all your adjustments, your closing balance over here would be 25,00150 minus 85,504 plus 5,000. So this is 24,19,646, 24,19,646, and the balancing figure should ideally be profit. So this is 21,25,975. So this is 293,671. Let me just verify this once in the statement of changes in equity. किधर चले गया? Yes, 293,671, exactly that same number. And you will show the equity component, issue of compound financial instrument during the year, the equity component. So that will give you a total of 28,44,000. So the total of both of these, 28,44,606, will be in your other equity. So 2419 है, and 424 कितना था? 960. So this will give you your total 2419,646 plus 424,960. You will also show that the opening capital and there is no change, so this is 28,44,606. That's perfect. 28,44,606. This is within other equity. 28,44,606, not a part of non-current liability. It will be a part of equity section. Then there is deferred tax liability. The net amount 254. So 474,850 minus 254,150, which is 2,20,700. This is deferred tax liability. Within borrowings, you will have 64 minus 424,960 plus 85,504. This is the closing balance in the liability component, 60,60,544. Long-term provisions, there is no change, so 524,436. Within other financial liabilities, this is 2,564 minus 81,265, which will be 1,19,299. Apart from that, trade payables will also be a part of financial liability, 669,180. There will be TDS payable, which will be 81,265, apart from current tax liabilities of 9,30,820. So if we just verify this, 28,44,606, convertible loan within financial liability of 60 lakhs, 60,544, long-term provision, deferred tax liability net of 2,20,000, trade payables 669, other financial liabilities 1,19,000, other current liabilities for TDS and 9,30,000, and that takes care of this question. You can refer all of these notes, and that takes care of question number 1. Okay, so the next question is actually more of an Ind AS 101 question, which deals with transition. It's covered under analysis of financial statements, but it's actually a part of Ind AS 101, a part of May 21 RTP. Let us go through this question. Him Limited, having a net worth of 250 crores, is required to adopt Ind AS from 1st of April 2012 in accordance with the Ind AS rules. Rahul, the senior manager of Him, has identified the following issues which need specific attention of the CFO. so that the opening Ind AS balance sheet as on the date of transition can be prepared. So there are specific issues based on which you have to give the guidance. The question requires you to give guidance based on what is the treatment as per Ind AS and how should you transition. We will just directly give effect to the adjusting entry. As a part of PPE, company has elected to measure its land at its fair value, which is permitted. As per Ind AS 101, the deemed cost can be the fair value as on the date of transition, or it can also be the previous GAAP carrying value. So we have taken fair value and want to use fair value as the deemed cost on the date of transition, permitted as per Ind AS 101. The carrying value of the land as on the date of transition is 5 lakhs and the land was acquired for a consideration of 5 lakhs. So this is at cost. However, the fair value of the land as on the date of transition is 8 lakhs. So basically your journal entry would be PPE, which is basically land account debit, which is 3 lakhs. You will have to increase the land by 3 lakhs. The corresponding credit is a slightly sticky issue. Institute has used different adjustments at different places. Sometimes they use the fair value reserve, sometimes the revaluation reserve, sometimes retained earnings. At that stage of transition, ideally you have to credit the other equity. Within other equity, because this is upward movement, they have taken into the revaluation surplus, which is permitted, but alternatively can also be taken to the retained earnings because it is on first time adoption, that is on transition. Though as per the institute solution, this is on revaluation, which is a part of equity, which is permitted. Okay. Second issue, under Ind AS, company has designated the mutual funds as investments at fair value through profit and loss. Okay. As per AS 13, current investments would be at cost or market value, whichever is lower. This is as per FVTPL. The value of mutual funds as per previous GAAP was 44 lakhs at cost. Maybe it's a long-term investment which may be taken at cost. However, the fair value of mutual funds as on the date of transition was 5 lakhs. So, well, you have to show these investments at 5 lakhs as per Ind AS. You have to increase the value of these investments by 1 lakh. 2, you will take the second effect to the retained earnings. It should go to directly to the retained earnings, not to the statement of profit and loss account by 1 lakh. Third, company had taken a loan from another entity. Acha, so this is loan taken, which is a financial liability. Acha, financial liability can either be a financial liability at amortized cost or at FVTPL. Ind AS 101 says that if it is a financial liability which is at amortized cost, you should ideally retrospectively restate the liability using the effective interest rate as on the date when the loan was taken. However, if that is not possible, then you can take the fair value as on the date of transition, make the corresponding adjustment to retained earnings, and going forward calculate the EIR based on the fair value as on the date of transition. Okay. The company had taken a loan from another entity. The loan carries an interest of 7% and had incurred certain transaction cost while obtaining the same. Okay, so that will impact the effective interest rate. It was carried at cost on initial recognition, which was fine as per previous GAAP. You could have taken this expense to the P&L as per previous GAAP. Ind AS requires you to adjust it against the transaction cost against the liability value. The principal amount is repaid in equal installments. So over the time, principal has been repaid. Interest is also paid at the end of each year. The fair value of the loan as on the date of transition is 1,80,000 as against the carrying amount, which at present is 2 lakhs. So you have two options. Either you retrospectively restate, for which you don't have enough information, or you take it to the fair value. So over here, we can't continue with the previous GAAP carrying value. So over here, your loan will be debited by 20,000. From 2 lakhs, you'll have to take it to 1,80,000. 2, you will give the second effect to the retained earnings also at 20,000. That is issue 3 resolved. Issue 4, the company has declared a dividend of 30,000 for the last financial year. On the date of transition, the declared dividend has already been deducted by the accountant from the company's reserves and surplus. Okay, so your retained earnings have been reduced to the extent of 30,000 and dividend payable has been grouped under provisions. It is not yet paid. The dividend was only declared by the board at that time and it was not approved at the AGM of the shareholders. Well, as per Ind AS, you can recognize dividend as a liability only once the right to receive is established, that is the shareholders have declared it, and hence showing this as a liability is wrong and hence you will have to reverse the entry. However, subsequently when the meeting was held, it was ratified. Does not really matter. You will recognize it when the right to receive is established. So retained earnings which have been debited will be credited and provisions will be debited. Provision will be debited by 30,000 to retained earnings 30,000. As per Ind AS as well as previous GAAP, both you will recognize dividend as a liability and an expense only once the right to receive is established. Issue 5, the company had acquired intangible assets under as trademarks amounting to 2,50,000. The company assumes to have indefinite life of these assets. As per previous GAAP, you would have written it off over 10 years. As per Ind AS, there is no such thing. You have to test it for impairment. You don't have a 10-year limit. The fair value of the intangible assets as on the date of transition is 3 lakhs. However, the company wants to carry the intangible at 2,50,000 only. Is that permitted? Well, yes, permitted, and hence there will be no entry. The fair value can be 3 lakhs. However, on the date of transition, you may either take the fair value or you may take the previous GAAP carrying value. So even previous GAAP carrying value is permitted, and as a result, you can very well go with the same value, so no entry will be passed. Point 6, after the consideration of possible effects as per Ind AS, the deferred tax impact is computed at 25,000. This amount will further increase the portion of deferred tax liability. So your deferred tax liability will be credited. So if DTL is credited, something has to be debited. So we will typically debit the retained earnings by 25,000 because this is on the transitionary impact. There is no requirement to carry out the separate calculation for deferred tax on account of Ind AS adjustment. So you will adjust the retained earnings by 25,000. Management wants to know the impact of Ind AS in the financial statements for its general understanding. We have discussed the impact for each of these issues separately. Prepare the Ind AS analysis report for him for presentation to the management, whereby you are required to discuss the corresponding differences between the IGAP as well as Ind AS. Typically, such a question where you are asked the IGAP treatment will not usually come. You will have to explain the Ind AS impact, which we have. For each issue for preparation on the transition date, also pass the journal entry for each issue, which we have. So this takes care of the second new question in the analysis of financial statements. Achha. Next, you have a few additions in the CSR as well as integrated reporting. In integrated reporting, there is barely a small theory question which is added. Integrated report, remember, is recommended by SEBI for, it's not mandatory, it is recommended by SEBI for the top 500 listed companies, though it is not mandatory. And where should the integrated report be shown? And is it to be shown as a standalone separate report like the auditor's report, or it can be integrated, or it can be a part of the annual report? Well, it can be either of the two. So it can either be shown as a standalone report, or it can be shown as a part of your annual report, or it can be shown at the starting, wherever. It has to be, it is recommended to be shown, but it is not compulsory that it has to be shown as a separate standalone report. In fact, if you look at the annual reports of Infosys, Reliance, etc., all of them have shown an integrated annual report. So it's a part of your annual report only. So integrated reporting, does an integrated report need to be a standalone document? Well, not compulsory. No, it can be a standalone document, or it can be also a part of your annual report. No, an integrated report can either be a standalone report, or it can be included as a distinguishable, prominent and accessible part of any other annual report or communication. For example, the annual report. It may be included in the front of a report that includes the organization's financial statements, like the annual report, which almost every company like Infosys or TCS or Reliance have been doing. Then is CSR. Three questions have been added in CSR. Also a clarificatory point where the CSR which is overspent can be carried forward, and it can be carried forward for a period of 3 years. Whether you are covered in the CSR provisions or not within that 3 years is not relevant. So it is possible that you are you spend, let's say, 10 lakh rupees under CSR, you had to spend only 8 lakhs, so 2 lakhs you can carry forward for 3 more years. In the middle it may be possible that you may no longer be applicable to CSR. That does not really matter. You will not get any refund. You can carry it forward for 3 years. Whether in those 3 years you are subjected to CSR or not, it does not really matter. After 3 years, that excess spent will lapse. One more clarificatory point. For a newly incorporated company or a company which has not completed 3 years, CSR spend is 2% of the average net profit. But if a company has not completed 3 years, how will you calculate the average net profit of the last 3 years? Well, जितने भी years हुए हैं, 1, 2, जितने भी years हुए, उतने साल का आप average net profit ले सकते हो. You don't need to necessarily wait for 3 years till the time you do CSR spending. And lastly, how is CSR applicable? Is CSR applicable for the group? So is it like India's that if it is applicable to one of the entities, it is applicable to every other entity? No, CSR is applicable company wise. So those limits of turnover, net worth, net profit, 1000 crores, 500 crores, or whatever, 5 crores as a case may be, will be looked at for each company with each unique corporate identification number separately. It is not something that is to be looked at from an entire organizational standpoint. Okay, keeping that into consideration, let us quickly glance through these illustrations. Question number 1, whether a holding or a subsidiary company of a company fulfilling the criteria of 135(1), that is CSR, has to comply with the provisions of 135 even if the holding or the subsidiary itself does not fulfill the criteria. The answer is a clear no. Merely because some other entity like a subsidiary or a holding company is covered by CSR does not mean your entity is also covered by CSR. Okay. Second, in the financial year 11-12, a company had spent 2 crores in excess. Okay, so you can carry it forward for 12-13, 13-14 and 14-15, 3 years, up to 3 years. In the year 12-13, it sets off 50 lakhs, which means you still have 1.5 crores remaining from such an excess. However, from 13-14, the company is no longer subjected to CSR provisions under 135. So be it. Since the company cannot take the benefit of set off for the excess amount spent in the previous financial year because of non-applicability, will the excess amount lapse? Well, yes, if you are unable to take the benefit, yes, it can be carried forward up to 14-15, after which it will lapse. If you are unable to take the benefit in 14-15, it will lapse. Okay, so this is question number 2. Next, you have question number 3. Company A is incorporated during the financial year 11-12, and as per the eligibility criteria, the company is covered under 135. Okay, for the year 13-14. Okay, so for the year 13-14, you have to look at the average profits for the year 11-12, 12-13, and ideally 10-11. But 10-11, it was not even in existence. Whether CSR provisions will apply to a company which has not yet completed 3 financial years of incorporation, the answer is yes. In fact, if CSR spending is required, you will look at the average profits of the last 2 years, and based on that, you will do the CSR spending. So that takes care of the 3 pointers linked to CSR. We will now go to a brief discussion of what is there in the amendments and then the conceptual framework, and that should take care of your discussion. Okay, so let us go to the beginning of our document. So the amendments, as we had said, under Ind AS 116 is the first place where there is a change. The lessees could claim the benefit of the practical expedient, that is was the shortcut in accounting. That is, they can take the changes in lease on account of COVID-19 that lessors have provided rent concessions. They can take the changes directly as variable lease payments in the profit and loss account. They don't need to adjust the ROU asset, and they don't need to take the interest rate as on the date of modification. They can take that shortcut for the rent concessions, provided the lease concessions are a direct impact of COVID-19, which is still the case. There's no the substantive change in the lease, which is still the case, provided there is the lease rentals remain the same or substantially the same, or they actually reduce, that is, there is no increase, which is still the same. And lastly, the rent concessions extend up to a period of 30th of June 2022. Earlier it was 30th June 21, now it is 30th of June 2022. So that is one place where there is a change, due to which in most of your illustrations where there was 2021, it has been replaced by 22 in the study material for the rent concession part, but there's no other change in the solution per se. In CSR, the carry forward of excess spent is permitted up to a period of 3 years. This was also there in the May 21 study material, but it is just clarified over here so as to remove any kind of ambiguity. We have also seen a problem based on those lines which the institute has added, and in On 24th of March 2021, the MCA along with the ICAI have issued a notification notifying the changes in the Schedule 3 presentation. This is to be applicable for financial period starting 1st of April 2020. This is to bring the financial statements in line with CARO. There are a lot of pointers. We will study that. It appears to be 20 odd points, significant 20 points. However, when you look at the Schedule 3 presentation, you typically do that for analysis questions or for business combination or consolidation questions. Rarely do these points even come in your main exam. So don't really be scared of the changes in Schedule 3. Most of the changes, almost all of them, don't really impact a student. Like you have to disclose if there are any Benami transaction proceedings, or if you have dealt with a company whose name has been struck off, or if you have been notified as a willful defaulter. All of these items you don't really use in the ordinary course of a student question. In practice, yes, these changes would result in enhanced level of transparency and enhanced level of disclosure. I'll run you through these changes quickly. There are 2 or 3 changes which are significant from a student standpoint. First, an aging schedule has to be given, like you used to earlier give it for debtors, less than 6 months, between 6 months and a year, 1 to 2 years, 2 to 3 years as a case may be. For debtors, which was given, is now required to be given also for trade payables, also required for work in progress and intangibles under development. So that aging schedule is required also for trade payables, which may be relevant from a student standpoint. And secondly, if there was a loan of 10 years where one installment is falling due within 12 months, then that one installment would be a part of current liabilities, which is still a part of current liabilities. Earlier you used to show this as a part of other current liabilities. Now it will be shown as a part of short-term borrowings. So these are the 2 changes which I think are relevant from a student solving standpoint. Other than that, the changes are there. We'll run you through these changes, but not really significant from a student standpoint. Okay, first of all, the shareholding of the promoters along with the change, like when you prepare the share capital note or schedule or statement of changes in equity, along with that you also have to give a details of the percentage shares, the number of shares which are held by the promoters, and changes if any during the period. The provisions which required rounding off into lakhs, into crores, etc. were earlier based on turnover. Now those limits are based on total income. Having said that, for a student standpoint, that was not as significant. Acha, point 3, 4 and 5 are what I would rate as slightly important from a student standpoint, where they have said that an aging schedule, loosely speaking, where you give the details of less than 6 months, between 6 months to 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years overdue. Payables as well as receivables have to be given. Earlier this was required maybe for receivables. Now it is also required for trade payables. Trade receivables also an aging schedule is needed, and also for capital work in progress and intangibles under development, that how long these assets have been under development, how long in years they are under development. So this is slightly significant, may come up as a part of presentation. Then disclosure of tangible and intangible assets. So if there is a significant changes which are more than 10%, and an explanation has to be given on the reasons for those changes. So this is more of an explanatory point, does not have much of an implication from a student standpoint. Revaluation of PP. If you have adopted the revaluation model and you have done a revaluation during the year, you just have to mention that whether that revaluation, the fair value, was determined by a registered valuer or not. So this is something which can come in the disclosures. So you have to disclose the fact whether the valuation has been done by a registered valuer or not. That's it. Then title deeds of immovable property. So you have to give a separate disclosure where you have to say that if there is an immovable property, are the title deeds in your name or are they in someone else's name and you are the beneficial owner, unless you have a right of use. So if you are a lessee, obviously the title deeds of the property are not in your name, it is a right of use asset. But other than that, the assets that you own, ideally the title deed should be in your name, and if they are not in your name, you have to give a disclosure on which assets they are not in your name and the reasons for the same. So this is more of an explanatory clause. Charge details, ideally as per the Companies Act, you have to register the charges. So if you have taken a loan and given a particular asset as a security, you have to register it, and if you repay the loan, that is, the charge is released, the satisfaction also has to be registered. If you have not registered charges or their satisfaction up to the due date, you have to give the reasons on why you have not done that. Again, more of a disclosure point. Short-term borrowings, this is something in red which I would rate as important. The current maturities of long-term borrowings are to be separately disclosed along with short-term borrowings. Earlier they were shown as a part of other current liabilities. Now they have been told to be shown under short-term borrowings, which according to me is an important change from a student standpoint. Achha. For borrowings from banks and other financial institutions, the law now says that if you have taken a borrowing for a specific purpose and you are unable to use the borrowing for the said purpose, you have to give an explanation on why you were unable to use it for the said purpose. So if a borrowing is for a specific purpose and they were not used for that purpose, reasons on why they were not used for that purpose, again an explanatory clause. Reconciliation. Typically you have to give quarterly statements to the banks. You may not present it to the world at large. However, if you have taken a loan, you might have to give quarterly or half-yearly statements to the banks regarding your performance, and sometimes the total of those quarterly statements does not tally with your annual financial statements. So if there is a difference between the quarterly statements that you have submitted to the bank and the numbers in the annual financial statements, a reconciliation for the same needs to be given. Again, as you can understand, from a student standpoint, it is not as significant, but for a practical world, this is a important clause. Gives a much more enhanced, transparent presenting framework, really helps the lenders a lot. The loans granted to promoters, directors and other related parties, if these loans have been given without a specific maturity date, then the reasons for the same and explanation for the same has to be given. If these loans have been given without specifying any terms of repayment, you have to explain, give disclosures regarding such loans. Benami property, if any proceedings have been initiated against your company under the Benami Transactions Act, give a disclosure. If you have been declared as a willful defaulter by any bank or a financial institution, you have to give a disclosure. If you have entered into transactions with companies whose names have been struck off from the registrar, you have to give a disclosure on why you have or disclosures of the transactions that have been entered. And this is something which is also important from a financial evaluation perspective. Now you have to give a list of ratios, the current ratio, debt to equity ratio, GP margin, NP margin, a list of around 8 to 12 ratios, where you have to give the list of ratios and probably even explanations for deviations in those ratios. So this is a fairly interesting point. So if there is a more than 25% deviation, then an explanation for the same also has to be given. If there's a scheme of arrangement during the year, generally what happens is if you go to a scheme of arrangement as per the Companies Act, you need a court or a tribunal approval, and sometimes the court or the tribunal suggests changes in accounting as compared to AS 14 or Ind AS 103. So in case your accounting is differing because of certain changes which have been required to be done as per the court scheme, then you have to give the details of those schemes. If there is any deviation from the accounting standards while giving effect to the scheme, the reasons have to be explained. If there has been a search or a seizure or a survey as per income tax and a certain undisclosed income has been subjected to tax as per income tax, then details of that undisclosed income, which was not earlier disclosed in the books of accounts, has to be disclosed. Slightly more guidance is given on disclosure in terms of the CSR report of the amount spent, not yet spent, carried forward, where the unspent amount has gone, how much is the provision, etc. And lastly, आजकल का जो buzzing word है cryptocurrency or virtual currency. If you have entered into any transactions or done deposits or made profits in transacting with cryptocurrencies like Bitcoin, Ethereum, etc., then you have to give a detailed disclosure regarding the same. So as you can see, these are the significant changes which are given under the Schedule 3. For you as a student, you have to remember that aging schedule is required for trade receivables, trade payables, capital work in progress and development assets which are intangibles. If data is given in the question, you will have to do that in your Schedule 3. Secondly, if there is a long-term loan and a part of that long-term loan is maturing within 12 months, then you have to give a disclosure within the short-term borrowing section of your current liabilities. If there is a revaluation, you have to, and details have been given, then you have to mention whether the revaluation, the fair value, has been determined by a registered valuer or not. And lastly, if there is details of ratios given, you have to give a certain set of ratios in your financial statements in the notes to accounts. So these are the changes under Schedule 3. Having said that, they don't impact in any ways your regular business combination or a consolidation schedule 3 balance sheet that you might have done in your class notes. There is absolutely no impact which these changes as such bring along in the questions that you have solved. Okay, then there is a conceptual framework for financial reporting. Now, what is a conceptual framework? It gives you an overall guidance on understanding what do you mean by assets, what do you mean by liabilities, what is income, what is expense, when should income be recorded, when should assets be recorded, when should liabilities be recorded. So it is a framework which is essentially for the standard setter like the IASB, International Accounting Standards Board, or the ICAI. So as a preparer of financial statements or as a student, this does not really have as much of a bearing. In fact, it is not even legally applicable or mandatory. For us to comply with the conceptual framework, we have to comply with the Ind AS. A standard setter, when the standard setter sets the accounting standards, these accounting standards have to kind of be in line with the conceptual framework. So it gives a guidance to the accounting standard setters on what principles to be used while formulating the accounting standards. They look at the financial statements to be from the principles of reliability, from the principles of faithful representation. The objective of financial statements is it should throw up information which is relevant, which is useful for the users of financial statements, like the shareholders, like the lenders, like the creditors, etc., which help them in making decisions on whether they should lend or they should transact with the entity. Financial statements are not representing the fair value of the entity or the saleable value of the entity. No, the equity as well as other equity are not restated to fair value. So it does not show the value that an entity will get if it were to sell its business. No, we are solving as per going concern. We don't even need to look at that. Again, the financial statements entirely are not based on either historical cost or based on fair value. They follow what you call as a mixed approach, and conceptual framework permits that, because in certain cases fair value may be a better base, certain cases historical cost may be better base. It is not necessary that you have to restate everything at fair value, because fixed assets you may not want to sell. Then what is the point of showing it at fair value? The cost of finding the fair value and showing it at fair value does not justify, and this is even mentioned in the conceptual framework. So conceptual framework, a new conceptual framework was formulated and issued by the IASB in 2018, and it is applicable for new standard setting which comes into effect from 1st of April 2020. For a preparer of financial statements, maybe the conceptual framework has its utilization, has its utility to the extent that if there is a transaction where there is no accounting policy, then like dealing in cryptos, for example, may not have a specific standard, then how will I show it? Crypto is just an example. It may be covered under a specific standard. I'm just telling you an example. So this conceptual framework you may read through for understanding how should incomes be recorded, how should assets be recorded, how should a faithful representation happen, and then decide your accounting policy. Or in case multiple accounting policies are permitted, like in PP, you are permitted to show using the cost model or the revaluation model. What basis should you look at while deciding whether you want to go using the cost model or the fair valuation model? So that is just a generic point. We will read the theory-based questions, not really important from an exam standpoint, but nevertheless, it's the illustrations and test your knowledge that is there. We'll quickly glance through and wrap it up. Okay, so when you look at conceptual framework, the conceptual framework assists standard setters like IASB or ICAI in the standard setting process. It will assist the preparers of financial statements to develop consistent accounting policies when no Ind AS applies to a particular transaction, or when an Ind AS allows a choice for formulating the accounting policy. The conceptual framework is not a standard and it does not override any Ind AS requirement. The conceptual framework is applicable to standard setting activity from 1st of April 2020 onwards. Okay, so this is your conceptual framework in module 1. Question number 1, let's quickly glance through it. If you know the general accounting standards, you will know the questions in conceptual framework as well. As on 31st March 2012, Natasha carried trade receivables of 280 crores in its balance sheet. Okay. At that date, Natasha entered into a factoring agreement with Samantha, a financial institution, according to which it transferred trade receivables in exchange for an immediate cash payment of, let us say, an X crores, 250 crores. 280 के सामने 250 आ रहा है. Okay, so what should you do? Should you de-recognize those trade receivables? Well, it depends as per Ind AS 109. We would have studied under Ind AS 109 that if you enter into a transaction which results in, let us say, a non-recourse factoring, that is, the risks and rewards of the cash flows of the debtors transfer to the factor. So it's non-recourse. Even if they receive 0 rupees, still the factor will bear the risk. And if they receive more than 250, then also the factor will take the reward. That is a non-recourse factoring, in which case the risk and reward is transferred, in which case you will de-recognize the debtors. However, if it is a recourse factoring, whereby in case there is a bad debt, the factor has a recourse to you. They can come running to you and recover the bad debts from you, in which case the factor is not a real risk taker. If there is some excess collection, the excess collection will come to you, then the factor is merely earning the interest income. So it's like a lender where debtors are taken as security. That is it. In which case there will be no de-recognition, because the risk of the trade receivables is still in the books of Natasha. So the accounting is based on Ind AS 32 essentially. 109. As per the factoring arrangement, any shortfall between the amount collected, that is 250, will be reimbursed by Natasha to Samantha, which means this seems to be a recourse factoring. So this seems to be a recourse factoring. Once the amount will be repaid to Natasha, the directors of Natasha once the trade receivables have been collected, any amounts above 250 crores less interest on this amount will be repaid to Natasha. So if the entire 280 crores is collected, the excess amount will come to Natasha. So the rewards are also there for Natasha. The directors of Natasha are of the opinion that the trade receivable should be de-recognized. The answer is no. Ind AS 109 specifically requires that you should not de-recognize it, because the risk and reward of the trade receivables is still on the entity, in line with the conceptual framework, which requires relevance and faithful representation. A faithful representation of this transaction would be to represent based on the risks and rewards of this asset. You are required to explain the appropriate accounting treatment in this transaction in the financial statements for the year ended 31st March 2012. You will show it as a loan transaction. So if you have received 250, your journal entry will be bank account debit to loan at 250. The trade receivables of 280 or whatever is the amount will continue to recognize in your books. And also evaluate this transaction in the context of the conceptual framework. So ideally the accounting over here will be governed by Ind AS 109 principles. Conceptual framework just gives you an overview that you have to ensure that a faithful representation is done, which will be done provided you show the debtors trade receivables in your balance sheet. Okay. So that takes care of question number 1. Question number 2, explain the criteria in the conceptual framework for financial reporting for recognition of an asset. Achha, what is an asset as per the conceptual framework? You would be aware an asset is an item which is a resource that is generated for the entity on account of past events. A resource which is controlled by the entity on account of past events, for which an entity expects to receive future economic benefits. Now these future economic benefits will be more, maybe less, maybe a high probability, maybe a low probability. As long as you expect that a future economic benefit will be received or is expected to be received, you can recognize it as an asset. It is something that has to be controlled by the entity due to past events. So that is the definition of the asset as per the conceptual framework. And discuss whether there are inconsistencies under Ind AS 38 for recognition of assets. Well, Ind AS 38 provides additional criteria. It just does not say that an asset is a resource which is capable of generating future economic benefits, so chalo usko recognize kar lo. For example, something like research expenses. There's a low probability that the research expense may generate future economic benefits, but it is not certain. And hence, Ind AS 38 requires a much more rigid, a much more stricter framework to recognize assets. It says, first of all, they have to be intangible, that is they have to be identifiable, non-monetary, lacking physical substance, then it should be probable that they will generate future economic benefits. There is a probability element over here as well. They should be probable, cost should be reliably measurable, and considering all of these, Ind AS 38 requires a much more stricter framework in recognition of an intangible asset. Yes, it is a little more stricter than the loose definition of assets given under the conceptual framework, because intangible assets lack physical substance, and hence the standard is fairly particular when it comes to recognition of intangible assets. So the reason for the differences between the general asset recognition and the slightly more stricter definition under intangible assets is due to the lack of physical substance that an intangible asset carries, due to which it makes it prudent to be extra careful before you recognize something as an intangible asset. So you can just refer that. This is the institute's thesis for this answer. इतना बड़ा आंसर आपको लिखने का जरूरत नहीं. You can write it in your own language. So like, I mean, for example, however, in terms of intangible assets, it could be argued that recognizing an intangible asset having low probability generating economic benefits would not be useful. Conceptual framework says useful होना चाहिए for users of financial statements given that the asset has no physical substance. So recognize तभी करो if you are fairly certain that will give a future economic benefit, for example. Then you have question number 3. The directors of Hind Limited are particular about the usefulness of the financial statements. They have opined that although the Ind AS implement a fair value model, well, Ind AS actually implement a mixed model, not a fair value model. Ind AS are failing in reflecting the usefulness of the financial statements as they do not reflect the financial value of the entity. What is the financial value? It's like the market cap. If an entity were to be sold today, how much value will it generate? So they are saying that Ind AS to fair value leta hai, but it takes the fair value of assets and liabilities. Maybe the fair value of the entity may be much more because of certain assets which are not recognized. Something like self-generated goodwill, etc. are not recognized in the financial statement. So even if you adopt a full fair value model, which the Ind AS do not, but even if you theoretically adopt a full fair value model, still it will not represent the financial value that an entity can generate if it were to sell the entire business. This is primarily because the objective as per the conceptual framework is not to show the financial value if the asset is sold. We are preparing accounts as per going concern. The objective of the financial statements is to provide information to the users like the shareholders, lenders or creditors in a way which helps them in making decisions on whether they should do continued transactions with the company or not, or is it safe to do transactions with the entity, or is it worth doing transactions with the entity. It is not to find the financial value or the sale value. The objective as a conceptual framework is not to do that, and hence equity is not remeasured in the financial statements as well. Discuss the views of the directors as regard to the fair value in Ind AS. First of all, we follow a mixed approach where certain items like PP, etc., intangibles can be shown at historical cost, an option to show at fair value. Inventories can be shown at cost as well, whereas certain items like financial instruments at FEOC, FETPL can be at fair value, amortized cost will be at cost, depending on the business model, for example. So looking at the usefulness, looking at what will be the more faithful representation, a mixed approach will be more suitable. And the fact that the Ind AS do not reflect the financial value of the entity, making special reference to the relevant Ind AS, well, and the conceptual framework, it need not, that is not the objective. The objective of the Ind AS is to provide information for users in making their business decisions, and not to find that if the company were to be sold today, how much will the company fetch. So that is not the objective, and as a result we follow the mixed approach, and we don't believe in showing the financial value of the entity as a whole in our financial statements. So the statement of the directors that Ind AS implement a fair value model is not entirely accurate. Though Ind AS use fair value and present value to some extent, it is not a complete fair value system. Ind AS are often based on the business model, on how an entity intends to use the asset, and the expectations of realizing the assets and liabilities through operations. Again, a detailed discussion about fair value and how fair value is calculated as per Ind AS 113, and the examples are given to you. The financial value, they have said that although Ind AS makes the use of fair value for assets and liabilities, the financial statements are not intended to reflect the aggregate value of the entity, as could be the notion among people. That is not the objective. The conceptual framework specifically states that the general purpose financial statements are not intended to show the value. So while a standard setter is setting the financial statements, the guiding point is, well, you don't have to make the standard in such a way that it shows the market cap of the entity. No, that is not required. Furthermore, such an attempt would not be fruitful, as certain internally generated intangible assets cannot be recognized under Ind AS. If you have to show the financial value, you will have to show the internally generated assets as well. Instead, the objective of the general purpose reports is to provide financial information about the reporting entity, which would be useful to potential investors, lenders in making decisions about providing resources to the entity, and not to sell the entire company. We follow going concern. Okay, then you have question number 4. Everest Limited is a listed company having investments in various subsidiaries. In its annual financial statements for the year ended 31st March 12 as well as 31st March 13, Everest classified Kanchenjunga, which is a subsidiary, as held for sale and presented it as a discontinued operation. Achha, when can you present something as held for sale? If it is available for immediate sale in the present condition and the sale is highly probable. This is governed under Ind AS 105. Achha, discontinued operation is slightly different. Discontinued operation is if you classify something as held for sale or if you have terminated the operations, then you can show it as a discontinued operation, and once it is classified as a discontinued operation, you can show the profit of the discontinued operation during the year as a separate line item. So this will help the readers in understanding how much will be the cash flows that will continue to be generated in the future years, because discontinued operation may not continue. Okay, on 1st of November 2011, the shareholders had authorized the management. They had authorized the management, 1st November 11, to sell all of its holding in Kanchenjunga within the year. So that is within 12 months. In the year to 31st March 12, the management has made a public announcement of its intention to sell the investment, but did not actively try to sell the subsidiary as it was still operational within the Everest group. Shareholders ने बोला बेचो, but management ने इतना active try नहीं किया. One of the conditions under Ind AS 105 for sale being highly probable is that the appropriate level of management should be committed to the sale plan, and the management should be actively marketing. So this does not appear that the management is actively marketing, and hence the sale is not highly probable. So to classify this as a held for sale may not entirely be correct. Then certain organizational changes were made by Everest Limited during the year to 31st March 2013, thereby resulting in additional activities being transferred to Kanchenjunga. So there are still changes that are happening in the year 31st March 13. So this clearly shows that as on 1st November 11 or on 31st March 2012, Kanchenjunga was not available for immediate sale in the present condition. One of the conditions is it has to be available for immediate sale in the present condition. The fact that the management is still doing what you say is reorganization in Kanchenjunga, maybe it is not available for immediate sale in the present condition. Additionally, during the year 31st March 13, there had been draft agreements. This is during the year 31st March 13, and some correspondence with investment bankers which showed in principle only that Kanchenjunga was still available for sale. So this is subjective. Over here, Institute has concluded that this is not enough evidence to show that the sale is still highly probable. The standard Ind AS 105 requires a fairly, it does not even say probable, it says the sale has to be highly probable. Merely having some correspondence with the investment bankers maybe does not still show that the sale is highly probable, and hence as per 105, as per the Institute's answer, this does not seem to be an asset which should be shown as a held for sale asset. Discuss whether the classification of Kanchenjunga as held for sale and its presentation as a discontinued operation is appropriate. The answer is no, it is not appropriate, at least not as per Ind AS 105. अभी अपन ज्ञानबाजी करेंगे by referring to the principles of the relevant Ind AS where no ज्ञानबाजी happens, which is exactly as per Ind AS. No. And evaluating the treatment in the context of the conceptual framework. Now, in the context of conceptual framework, a faithful representation and relevance would require that if you are sure that you want to sell this asset, ideally in your income statement, your incomes, your taxes should be separately shown. Your income statement should faithfully represent only those assets which you or those incomes which you expect to continue to be on Kanchenjunga, because it is not expected to continue. I mean, as per the strict principles of Ind AS 105, it cannot be classified as held for sale. But in substance, if you look at the principles that conceptual framework looks at, there is a slight degree of inconsistency over here, because ideally the conceptual framework says that a faithful representation in the financial statements should show this as a discontinued operation, because ultimately whether it meets the strict conditions of sale being highly probable or not, it is likely to be discontinued, in which case the readers, when they look at the financial statements of the current year, they should be aware that there will be a part of the income, let us say which is earned from Kanchenjunga, which will not be continued in the future. So there is a slight degree of inconsistency in the strict Ind AS 105, which the standard setters have decided, versus the general principles under conceptual framework. Sir, हमें क्या follow करना है? Obviously Ind AS 105, because conceptual framework does not override any Ind AS. So over here, if you go to see, in terms of conclusion, you can read this entire thesis that the institute has written, but at the end, based on the information provided, it appears that Kanchenjunga should not be classified as a subsidiary held for sale. Instead, the results of the subsidiary should be reported as a continuing operation for the years 31st March 12 and 13, largely because the sale is not highly probable, and in 31st March 12, along with not being highly probable, the asset is not even available for immediate sale in the present condition. Okay, evaluation in the context of conceptual framework, this is just a theoretical discussion. This cannot override the treatment given under Ind AS. Okay, where is this? Okay, the conceptual framework states that the users need information to allow them to assess the amount, timing and uncertainty for the prospects of future cash flows. So you have to give information. You don't have to give forward looking statements, so you don't have to predict the next year's cash flow, but you have to give information which aids the readers in predicting the future cash flows. Highlighting the results of discontinued operations separately equips the users with information that is relevant to this assessment as a discontinued operation, will not contribute to the future. So ideally, as per conceptual framework, you should show this as a discontinued operation. If a company has made a firm decision to sell the subsidiary, it could be argued that the subsidiary should be classified as a discontinued operation even if the criteria to classify it held for sale have not been met. But ये तो सिर्फ theory है, because this information would be more useful to the users. However, Ind AS 105 was developed with a high degree of strictness on the classification. Accordingly, the decision could be argued to be in conflict with the conceptual framework. What will be applied? Obviously, Ind AS 105, this is just a theory discussion on the conceptual framework. And then we have the last question. Let us read question number 5. The directors of Giant have received the following emails from its majority shareholder, that is to the directors of Giant, regarding the measurement. I recently read an article published in the financial press about the mixed measurement approach that is used by a lot of companies. Okay, so someone has written that they have read that companies are using mixed measurement, which is what Ind AS permits. That is used by lots of companies. I hope Giant does not follow such an approach, because a mixed approach seems to be inconsistent. So assets may be recorded as inconsistent values. I believe that consistency is of paramount importance and feel that it would be better to measure everything at a uniform manner. Well, that may not really reflect the essence of the item. If you measure every item of PP at fair value and you don't intend to sell them in the near future, it will be a very costly exercise and it may not really represent what the management is expected to receive. Management is going to use it. It will be costly as well as less meaningful. So mixed approach is permitted. It is not an inconsistent approach. While developing the conceptual framework, they have said that you have to trade off between the time and the cost and the usefulness of the information. So here, making everything at a single base may not really be as useful to the reader as the investor believes. In any case, I'm not going to do a piecemeal dissolution, so it does not really appear to be as useful, and the cost and the time that will go will not really help the users in making a meaningful judgment. It would be appreciated if you provide further information in the next AGM on the measurement basis, covering what approach is taken by Jayant and why, and the potential effect such an approach has on the investors trying to analyze the financial statements. Prepare notes for the directors to discuss the issue raised by the shareholders' email with reference to the conceptual framework. Well, as per the conceptual framework, a mixed approach is recommended and is permitted. You don't need to have a single consistent base, as we have discussed. It is important to note that figures in the financial statements cannot be derived by following a one-size-fits-all approach. Such an approach may not provide the relevant information to the users. A particular measurement basis may be easier to understand, more verifiable, and even less costly, like historical cost in certain cases, and therefore to state that the mixed measurement approach is inconsistent is a poor argument. In reality, a mixed approach may actually provide more relevant information to stakeholders, and if every company is following the mixed approach, it is a lot more comparable as well. Perfect. So this takes care of the discussion of all the questions. What I'll do is probably I'll try to, in my opinion, whatever are the important questions that you should revise, I will just mark them off. You can just ensure that you revise these either as a part of your notes already done or as a part of these. In any case, I hope these lectures have been helpful. I'll just quickly mark off the important questions. Okay, so because conceptual framework they have put as a new question, I'll just recommend you read them off and finish it. Question 1 on Ind AS 1 is important, that offsetting question. Interim is okay, cash flow, both questions are okay. Accounting policies, the second question which involved that latent defect adjustment is interesting. Fair value measurement, the question, what I've marked over here on 113, which is on that present value for decommissioning obligation, is important. Government grants, the deferred grant question is interesting. In PPE, the question which is involving the revaluation model application is an interesting question. Leases, both the questions I would rate as important. Borrowing cost ke andar, the second question is a slightly new question, you can refer that. In agriculture, the first question is an important question. There is a theory question which is the third question as well, which you can rate as important. Income taxes, also the business combination question is important. Within foreign exchange, the second question which involves the foreign exchange along with loans is important. EPS question is definitely important. Financial instruments question is important, you would have done that. Business combination, definitely a very important question. Joint arrangements important, the first question. In analysis of financial statements, the first question, that is a new question, is important. And within CSR, CSR, all the three questions you can refer. So this is based on my understanding, approximately half of these questions. But nevertheless, I hope these videos have been helpful. Thank you very much for your time, and we'll stay in touch. If there are any further changes or revision videos, I will upload them in the near future. All the very best. Do well. Take care.